Hello, everybody. My name is Ludwig. I'm Senior Vice President, Investor Relations, Communications and Marketing at DEUTZ. Today, I would like to present you our full year results for the year 2023. Before we kick it off, please have a quick look at the disclaimer at the beginning of the document. I'll start with an overview of our fiscal year 2023 and a strategy update, follow through with our numbers and the guidance for 2024. 2023 was a very profitable year of growth for DEUTZ. We had a very solid top-line development with a 3% growth in number of engines sold, 7.6% growth in our service revenue to 484 million, and a 7.8% growth of group revenue to 2.1 billion. But even more important for us was the significant increase of the bottom line. The EBIT margin of the group came in at 120 million or 5.7%. That's a 35% increase versus the previous year. At 7%, the EBIT margin of our continued operations was even higher, with a number of 144 million. And even better, our classic business EBIT margin came in at 8.8% or 180 million absolute figures, a growth of 40% versus the previous year. And this is very important for us because we're able to meet our guidance for the third year in a row. After 21 and 22, now in 2023, we met our revenue target and came in at the high end of our EBIT margin target with 5.7%. And also on the free cash flow side, with 55.9 million, we met our mid-double-digit million euro amount target that we gave at the beginning of last fiscal year. But now let's have a look into the future. As you all know, we had a slightly difficult year with respect to the order intake trend. You can see here that since beginning of last year, in every quarter, we saw that a decline in the order intake was the name of the game, as some of our end markets were a little bit in a more difficult situation. We believe there are two reasons for that. First of all, of course, the beginning of last year was also influenced by our fixed volume program, where we believe around 100 million of order intake that we received can be put down to that program. That increased our order intake artificially. And also we're seeing a normalization of our supply chain and the order intake as the supply chain has eased up and it's become a lot easier to gain parts in an appropriate time. And what is even more important for us, indicative, the new orders in the first quarter of 2024 are already rising again. So we believe that we have passed the trough already. And the most dynamic region for us remains the US, which also carried us through last year. And also in the beginning of this year shows us that there the business is growing while we have a little bit more difficulties in Europe. Now I would like to give you a little bit recap on where we stand with our Dual Plus strategy. We have the three segments, DEUTZ Classic, DEUTZ Green, and DEUTZ Service. In the classic business, we want to enhance our profitability and play an active role in the consolidation of the market. In our DEUTZ Green, we want to build relevant ecosystems with products and technologies to become a long-term profitable player in that area as well. And with our profitable service business, we want to grow through organic and inorganic growth around the world. And all of these three aspects of our Dual Plus strategy already contributed in a very positive manner to our 2023 performance. As you can see, starting from our adjusted EBIT in 2022, Classic, Service, and Green all contributed strongly to the adjusted EBIT of continued operations of 144 million. All in all, we had a 61% growth in adjusted EBIT in our continued operations. Of course, as we still have Torqeedo in our books and the sale will only close this year, the reported adjusted EBIT for 2023 is only 120 million. So we have to deduct Torqeedo again from that. But you can see with the measures we have undertook, all three parts of our Dual Plus strategy are contributing. And we go into a little bit more detail. Let's talk about the segment highlights of our classic business. We were able to conduct two strategic partnerships last year that underlines that we're active in the market consolidation and that we have come one step closer to our goal of becoming one of the top three independent engine producers by 2030. The first partnership we struck was with Daimler Truck for the HSHEP and NDEC engine platforms. This business will be implemented starting in 2028. And then we were able to strike a deal with Rolls-Royce Power Systems, who is currently the distribution partner of Daimler Truck for these engine platforms into the off-highway market. As this business is ending for them in 2028, they agreed to go into discussion with us how we can take over this business already by mid of this year. So we are very close to a signing here, and we still believe closing will be possible by mid of the year. So we do expect that in the second half of this year, we will starting to sell HVAC and MDEC engines into the highway segments. But we're also quite successful with our performance improvements. As you can see in our margin development, we were quite successful in the continuation of our pricing campaigns. Also, we're able to enhance production and automation, increasing our efficiency in our factories. And we reacted quite flexible with our capacity management. The third shift that we had installed in the second half of last year, now with reduced demand, has already been phased out as of February. And we're also dealing quite successfully with the management of suppliers' price increases. For 2024, reducing material costs is one of our key focus areas. Now let's have a quick look at the service highlights. We implemented a growth strategy a couple of years back, and as you can see, it is clearly bearing fruits. Where we always had a nice growth in the business, it really accelerated since the COVID crisis in 2020. With an annual growth rate around about 12%, we are very proud that we achieved 484 million this year, and we are very confident they will reach our goal of 600 million by 2025. Key developments here are the expansion of the service network and also using innovative approaches like the technician in the van. And also M&A plays a significant role here. We had contributions from our investments in South Coast Diesel and Ausma, which were done in 2022. And also we saw the first revenues of DEUTZ Nordic and Hochschild, our acquisitions we conducted in 2023 last year. Finally, looking at the green business, clearly one of the highlights was the divestiture of Torqeedo. With the sale of Torqeedo to Yamaha Motors, we believe we have found really a best owner for this asset. It is an important step for us in the ongoing process of repositioning and finding the green segment a good place. The basis to focus on more customer-oriented approach towards green drivetrains. The key aspects of the transitions we're taking out an EBIT loss of approximately 23 million. The signing was already done in January, a closing expected after Easter. Cash in from this transaction is expected in the high double-digit million euro range. And the book gain, they will most likely already show in Q2, is expected to be in a low double-digit million euro range as well. So overall, with the divestiture of Torqeedo, we have undertaken an important step in the refocusing of our green segment. And now I'd like to close on the strategic session with a quick outlook on our focus for 2024. Clearly, for DEUTZ Classic is the integration of the Rolls-Royce power systems starting mid of the year. We will continue with our performance focus to reduce material costs, to optimize our shift systems, and to become more efficient in manufacturing. And we'll continue with our market consolidation. This year, it's probably more about screening for the right acquisition targets than actual deals, but we will always be ready to act if an opportunity pops up. And of course, we're already starting to looking at winning new customers for the above 4-liter segment, where also the future Daimler and Rolls-Royce engines will play a role. On the green side, we'll implement the ramp-up of our hydrogen gensets. We will close the Torqeedo deal, obviously, and focus on additional green activities. And on the service side, it is about continued organic growth and further M&A in preparation of reaching our 600 million goal next year. With that, I would like now to give you a quick view onto our full year 2023 numbers. First of all, please, because we talked about it a couple of times already, have a look at the comparison between the overall group figures and our continued operations. With the deconsolidation of Torqeedo, you will see that our unit sales come down quite significantly with more than 36,000 units. But as this is only the Torqeedo engines, which are very low in average sales price, the impact on revenue is marginal, only the reduction of 1.9%. On the other hand, adjusted EBIT goes up significantly by more than 20 million. The margin increase is 1.3 basis points to 7% when the Torqeedo's numbers are taken out of our continued operations. Now, focusing on continued operations, let's have a quick comparison between 22 and 23. Overall, we already discussed this, new orders came in softer with a decline of almost 12% at 1.75 billion. On the other hand, unit sales increased for the DEUTZ engines by 3.2% to 187,160 units. And we had a disproportionate revenue increase of 9% as stated before, the pricing increases continued to play a role here. So with more than 2 billion and a growth of 9%, this is really a record year for DEUTZ with respect to the revenue number for this century. Orders on hand had normalized, as also stated before, to a level of 450 million for the continued operations, down from 766.5 million last year. Now let's have a quick look at our revenue growth in detail based on the breakdown per region and per application segment. All regions actually still contributed last year to the growth. The big driver being, of course, the Americas, especially with the US, where we increased the share to 25% of the business. But also Europe, including Germany, showed a very solid development with a growth of around about 4%. Asia Pacific was weaker, but especially China is playing a role here, where it did not see a lot of growth. And if we look at our application segment, you can see that material handling, which is a mainly US-driven business, was the most important growth driver here. It already now has a share of 23% of our revenue breakdown. Also, our service business held up very well, also keeping this service share at 23% very stable. For the construction business, only a slight growth. Already here we saw some slight demand decreases from the industry, and in agricultural machinery, we actually had to post a small decline with 1.1% already. These two segments will, of course, be a little bit weaker in 2024, as we believe. Now, more important than this revenue development is, of course, for us, our profitability improvement, especially in the continued operations. As you can see, we had a very stable development over the 4 quarters in 2023. But while Q4 was the weakest with respect to margins, in absolute terms, with 37 million, it was our strongest quarter. And you can also see that there's still a strong improvement versus the previous year, with growth of more than 6 million or 1% in margin terms. Overall, with 143.6 million in adjusted EBIT for continued operations, it was a great result for us, driven by the expansion of our service business, by the market-oriented pricing, and the cost-saving measures we implemented. With a margin of 7%, an increase overall of 1.5 percentage points. But we also have to mention that there were extraordinary items in the magnitude of 20 million, which led to a discrepancy between the adjusted earnings and the EBIT. So these extraordinary items are mainly due to impairments on capitalized R&D. Our consolidated net income, therefore, was only slightly up year over year, and the earnings per share were actually flat at 66 cents because we had a higher number of shares for 2023, as we had a share increase in kind with the takeover of the Daimler Truck license and IP business. Very strong improvement in earnings, of course, also is reflected in our cash flow and net financial position. Cash flow from operating activities increased by more than 80 million, and the free cash flow before M&A increased by more than 60 million to 55.9 million, reaching the mid-double-digit range that we had guided beginning of last year. And if you look at the continued operations, you can see that the taking out of Torqeedo will actually improve our performance there as well. The free cash flow before M&A actually grew to almost 73 million for the continued operations last year. Our situation there was more or less unchanged because, of course, we had some cash outs for M&A and also our dividend had to be paid, but overall, we're very well financed from a balance sheet perspective. You all can see this here. Our equity ratio actually increased slightly to 46.7% as the equity grew to 743 million. Our net debt to EBITDA level was very solid at 0.7. And we are again paying a dividend of 17 cents per share. This is a 2% increase versus 2022. Overall, we have sufficient financial firepower for our further inorganic growth. Now, I'd like to close with a look at our guidance for 2024. First, let's have a look at our global market forecasts. We really talked a little bit about it. The situation is not as strong as it was in 2023. In all our 3 key regions, we expect that agricultural equipment will see a slight decline. Construction equipment overall, we expect it's going to be flattish. And for material handling, there's a mixed picture here. EMEA, Americas, more or less flat. We see a slight increase potentially in Asia, but that is, of course, the smallest market for us. So overall, we expect our end market slightly weaker or stable in 2024. And based on that, for the overall DEUTZ Group, we expect a stable operating performance this year. On the unit sales side, obviously, with the weaker end markets, we expect a decline to 160 to 180,000 engines. Revenues should be flat between 1.9 to 2.1 billion, and also the adjusted EBIT margin should more or less be in the range we saw this year with 5.7%, adjusted EBIT margin in a range between 5 and 6.5%. For revenue and adjusted EBIT margin, of course, the agreements with Rolls-Royce and also the anticipated divestiture of Torqeedo play a significant role that will keep us in those ranges. And for the free cash flow, we expect that we should again be able to post a mid-double-digit million euro level. So thank you very much for listening. I hope I could yet spike your interest, and if you should have any questions, please contact us at the DEUTZ IR department. Our Q1 statement will be out on April 30, and our annual general meeting will be held on May 8. So those will be the next 2 data points. I also will use this opportunity to say goodbye, because this has been my last financial report for DEUTZ. I am leaving the company. I will be handing over to my successor, Mark Schneider. He will be talking to you going forward, and I'm sure he'll be doing a great job just giving you the highlights of the DEUTZ investment case. Thank you very much, and goodbye.